were trading messages over the weekend, and I think that maybe the best one-liner that you threw to me was just a text that said, "The stock market is gambling," and it kind of is.
Look, Chris. Let me just put it out there. I don't want to start fights with people, right? No, I look. I'm invested.
Yeah,
but I look.
We're all invested, Orphe, one way or another. I think the number of Americans that have some connection to the stock market, it's got to be it's a very, very high number.
All you have to do, look, why did I say that? I said that because look at valuations today. You're right.
Well,
you'd have to go.
Well, hold on. I'm going to call a timeout. No. I'm going to tell you why you said that. And I mean, just to, I mean, we're both getting up there in age, right? Because Friday was a disaster. That's why you said that. I mean, the Dow Jones fell almost 2%. The S&P fell 2.7%. And the NASDAQ, where, we talk about technology and artificial intelligence and computing on this show, all the time, whether we talk about it directly or indirectly. I mean, you and I, our lives are tied to those things, right? Not necessarily AI, but certainly to technology and to computing. The NASDAQ fell 3.6% on Friday because of this ongoing tension, between the United States and China. President Trump said that there'd be a quote unquote massive increase in tariffs on Chinese goods. And, I don't have the, President Xi of China's, direct quote, but, it wasn't good and the market didn't like it. And as a consequence of that, if you looked at the chart, it looked like somebody falling off of a cliff. And yesterday or Friday afternoon, the last trading day of the afternoon was, if you were glued to your set, I was not. It probably was terrifying because it just looked like there was no bottom. That literally the line was vertical and pointed downward. So
it makes you wonder, right? Like if all of this is so fragile that one headline, one tweet can bring it all down. I don't know. It's a little bit worrying, right? And, that's one thing. The other thing is, just look at valuations. They're out of the world. They're out of let's think back. Okay. 1988, the dot-com bubble, right? And that's what comes to mind.
Yeah. Right? 1998.
Oh no, 1988 first, right? We had a sustained period.
Okay.
In this, yes. And in 1998 to 2002, right? Yes.
Sorry, I'm speeding your story up.
Since late 2019, the S&P 500 up, I don't know, 100 and something percent, 120%. It's literally what's happening is the earnings growth isn't quite there, isn't keeping up. And so you start to wonder, okay, how much of it is real and how much of it is just what Schiller called irrational exuberance. This idea that investors are just exhibiting herd behavior and AI's everywhere. And so AI, right? The fear of missing out. This optimism, that's this unfounded optimism, right? That's pushing these, asset prices ever higher. And so that I don't know. That's the big question, right? Another speculative bubble potentially.
Well, what we're looking at here is unprecedented. And and if you go back, in the last 5 years, if you go back to sort of, Trump 1.0 and the economy, and that economy was growing quickly and the markets were moving with it. There was a lot of enthusiasm. COVID comes along and, we go from, hey, this could be a problem to this is a problem to, hey, we're going to shut the entire country down. And, 2 weeks to flatten the curve became, frankly, about 2 years of mandates and extended emergency orders at the state level because the federal government turned it over to the states and let the states decide how they were going to operate. So you had a real unevenness in terms of economies at the state level. And the market in the midst of that, there was, remember, if we go back and we listen to the tapes that you and I, would have made, say in like 2021 or 2022. I think we started doing this show in 2021. I could be wrong about that. You and I have certainly been talking about this for a long time, whether we did this, on a recording or not. The question was, what would be the shape of the recovery? Would it be U-shaped? Would it be, but it was V-shaped. And I mean, if you look at it objectively, I mean, there was a nadir, but then the recovery from that was pointed almost straight up in the air. And so
let's add a layer to that.
Please.
K-shaped.
Yes, and that's an interesting dynamic, right?
Let's add another layer, right? It was the recovery has been driven by so we get the V shape first, right? Yeah. And all the labor shortages, blah blah blah, but not enough to sustain it, right? Right, excess savings dwindled. Lower income families are now in trouble. While you have this kind of small group at the top that continue to spend.
Right. Well, and also massive stimulus times 3 in that window of time. I mean, massive stimulus. So the printing of money, the increased
asset valuations up.
Yes.
All that stuff.
Yes.
For sure. And I guess the big question is, how far disconnected from fundamentals are we, in terms of asset prices, right?
Well, there are certainly new norms. And in terms of price, like price earnings ratios, it's, I think things that would have been intolerable, by those deeply invested in the market, those on the front end, which said, no way, we can't do this. This is not good for anybody. It's not good for our clients. They've kind of just said, well, you know what? We're in a new space, and everybody's come riding along with that.
That's right. Because that's what innovation tends to do, right? It's like innovation tends to push asset prices high.
I say that not as a negative or as a shot, but I think it's like is it, and maybe we'll close on this answer. Have we just become accustomed to something that is new and foreign and unprecedented?
I don't know if we've become, I think there's more of there's really a fear of missing out. There's hey, this is this new technological revolution. And if I'm not part of it, I'm getting left behind. Right. I listen to shows like the halftime report, CNBC's halftime report. And one of the things I hear is the cost of not being in it is too big. Right? It's just like, oh, look at that. If you didn't have NVIDIA in your portfolio, oh my gosh, the cost is massive. Right? And so imagine managing someone else's money and you didn't own NVIDIA. I mean, you're getting fired. You're getting fired. Right? And so, so that's the thing. So, and so, of course, unfortunately, that means more and more people will be drawn to this kind of AI wave. And the big question is whether or not, we're actually it's actually going to show up in real economic progress, right? Because it's not yet. Sure.
Well, let's hold that thought, because I want to do the next episode on AI and what we see so far.
And I think one of the things, the most important thing here is this idea that what bubbles do is they lead to this overinvestment and and essentially a misallocation of resources.
Mm-hmm.
Right? Imagine all of that money that's been dumped into the AI, right?
Mm-hmm.
Could have been spent elsewhere. And whether or not this was the right way of allocating capital, right? We're going to find out, and we're going to find out real soon.
All right. We're going to talk about that. All right. So let's call it good right there. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics, wherever you get your podcasts. Make sure that you watch Orphe and me each week, and certainly listen to the Center Square Radio Hour.